What is going on, you guys? Welcome back to the channel. So in this video today, we are going to be talking about compound interest as well as the top 10 investments out there that can enable you to begin earning compound interest. So for those of who are not familiar with compound interest, one of my favorite sayings out there related to this comes from Albert Einstein. And what he said in regards to compound interest is that he who understands it earns it, and he who does not pays it. And that right there is pretty much the biggest truth surrounding compound interest out there, is the fact that those who understand how it works and how to deploy it can use compound interest to build massive amounts of wealth or even generational wealth for their family members. On the other hand, those who do not understand how it works actually have compound interest working against them through compounding debt. So at the end of the day, you can have your money working for you, where your money is growing into more money and you're earning interest on interest. The definition of compound interest. That is how you should have compound interest working for you. But on the other hand, a lot of people have compounding debt where they never pay down their interest or their principal on their loan. They're accruing interest on interest year after year, and they're essentially somebody else's form of passive income and compound interest, but they're making that money for, the big banks, and that's just not an ideal situation. So I'm going to be covering with you guys how to use compound interest in the right way, also how to avoid compounding debt, and some ideas of what you may want to do if you're currently in that situation. I also love talking about compound interest because, in my opinion, guys, this is one of the most fair and equal opportunities out there. Because at the end of the day, we unfortunately still live in a world where, based on the way that you look or the way your voice sounds or your gender and different things, there is some unequal treatment in this world. However, when it comes down to compound interest, assuming that you are, in a country where you're able to participate in the global financial markets, it does not matter who you are, what your name is, what your past is, doesn't matter. Anybody out there has the same opportunity when it comes to compound interest. So that is why it is one of my favorite lessons out there. And I can remember when I was younger, the first time I came across this was when my dad, showed me a compound interest calculator at about 11 or 12 years old. And while a lot of people have had lessons like that early on, there's a far majority of people who may have never heard of this before. And so basically it's just not to, beat a dead horse here or, overly go into this introduction too much, but I just want to instill this in you here, guys, that if you follow, these ideas of how to earn compound interest and you were to do this for the rest of your life, this video right here literally has the potential to make you a millionaire and change the path of your entire family for generations going forward. Now, that being said, just to be respectful of your time here, let me tell you what we're going to be covering in this video. First of all, we're going to be talking about why investors should be making compound interest a top priority. We're going to discuss how the rich have been leveraging these types of investment vehicles for thousands of years to build their wealth and carry on wealth from generation to generation. We're going to cover the key tax benefits offered by compound interest investments, as well as the 10 top investment opportunities that could allow you to earn compound interest in 2021. We're going to cover the crucial steps you need to follow when researching and potentially purchasing these assets, as well as the biggest mistakes to watch out for when buying compound interest investments. So we're going to cover a lot here. As a result, I do have a few small asks from you. First of all, if you are watching this on your phone, that's totally fine. But if you're on your computer, maybe put your phone on silence or just put it away for now. Don't get distracted halfway through here, guys. We're going to unpack a lot of information, and you're not going to have to jump around to like 15 or 20 videos or something like that. It's going to all be right in this video, like a mini college lecture. So I would appreciate it if you guys could, invest your time, since I've invested mine in this video, and just try to minimize those distractions. You might also want to grab, something to write with and a pad of paper, as well as a beverage. And real quick here, guys, for my lawyer, a couple of quick disclaimers. Number one, I am not a financial advisor, and this is not any kind of financial advice. You should always do your own research and due diligence before investing in anything out there, and this video here is for entertainment purposes only. There are no sponsors for this video here, guys, just to throw that out there. And also keep an eye out down below in the comments. There have been a lot of spam and scam comments. So if you see anybody down there saying, hey, you know, if they're pretending to be me and saying, send me money to invest in crypto or anything like that, that's 100% a scam. I'm never going to contact you on like WhatsApp or anything like that, or ask you to send me money. So be careful. Watch out for scams down below. So that being said, let's jump right into the very first topic here with a quick explanation on what exactly is compound interest. Well, at the end of the day, compound interest is similar to building a snowman as a child. And if you guys were anything like me, you were probably terribly impatient with that initial snowball, and then you're on your knees rolling it around in the snow, not seeing any progress, and you're kind of wondering, hey, you know, is all of this effort for naught? That is typically, you know, what the first couple of months, if not years, can be like as an investor. You're putting a lot of effort in, you're putting money in, you're packing up that ball of snow, but you're starting off with such a small amount that, you know, the incremental small differences are just difficult for you to notice. However, once that ball of snow becomes larger, there's actually a greater surface area for that ball to then pick up more snow. So it's one of those scenarios where the larger that ball of snow becomes, the more snow that ball can pick up, and as a result, the larger that ball becomes. So that is what compound interest is like. Starting off with a simple snowball, building it into this gigantic ball of snow, and then many years later, or for people who are very well off, the way I describe it is it's like you took this ball of snow and then you rolled it down the side of a snowy mountain, and then you're standing there at the top of this mountain watching that ball of snow just building and building, picking up more and more snow as the further it travels, and you're just standing back there in awe at what you created. That is pretty much what compound interest is in the most, you know, simple analogy out there that I could come up with. And just to mention, guys, I did not come up with this analogy here, guys. I may have explained it a little bit differently, but hundreds of people have called compound interest the snowball effect. There may have even been a Warren Buffett quote, to be honest with you there. I've got a lot of different tidbits of information. I don't always remember the sources here, guys, but I just wanted to clarify, I am not saying that I came up with that idea here, but I always did like that comparison, and it really does help with first-timers to grasp the concept of compound interest. So with compound interest, there's two ingredients to this recipe that you have control over. Number one is the amount of time that you invest your money for, which is the biggest factor that you have control of. And number two is the amount of money that you invest, which in most cases, we have very little or almost no control over that, depending on our situation. But the good news is, I promise you, and I'm not just saying this, the number one factor that is most important is not how much money you invest. It is how often you do it and how long you do that for. So if you're younger, you should be glad, because the most important ingredient to this recipe, which is time, is on your side, and you can honestly set yourself up for massive success financially later on in life with very minimal effort. Unfortunately, if you're in your 30s, 40s, or 50s, you know, you don't have nearly as much time to allow that money to grow, so that is not, you know, the same advantage that a younger person might have. However, at the end of the day, don't get discouraged, because the best day to begin investing is right now, assuming you are financially ready to do so. So even if you are older in life and maybe you made some mistakes in your 20s, 30s, or even your 40s, don't be discouraged if you're starting off later in life. There is still a lot that can be done. Now, as far as what to look for in compound interest investments, here are the different criteria that I pay attention to. Number one is consistent cash flow. This is the most important factor here, in my opinion, because In order to earn compound interest most effectively, you want to have an investment that spits off some cash. That way you can put that cash back into the original investment. While growth stocks do show compounding returns, for example, the S&P 500, it's a little bit different because you're not earning any, dividends off of that investment. You're solely relying on, that underlying asset appreciation. So that is why the majority of my entire net worth is invested in blue chip dividend stocks. And personally, that is my favorite form of, truly passive compound interest income. So that's why cash flow is so important to me for things like, rental properties or dividend stocks. These investments got to be throwing off some cash that can be reinvested back into the original investment to earn, in my opinion, the most effective form of compound interest. Beyond that, of course, you want to look at the track record of an investment. If you're earning compound interest, this could be a 25, 50-year investment here, so you want to make sure you're investing in durable, time-tested assets. Beyond that, consider the risk profile. You may also want to look into creating a well-rounded investment portfolio and figuring out your individual risk tolerance. I have a full 1-hour crash course on investment portfolios for beginners. I'll throw that up in the corner there, guys, if you want to check that out at the end of this video. And then lastly, you do want to consider the liquidity in case you need to get your money out of this investment if you were to need it. So just to give you guys an example from my own portfolio, I have a lot of my money in blue chip dividend stocks, but I also have some money in crowdfunded real estate. Both of those investments earn me quarterly dividends, and both have dividend reinvestment in order to earn compound interest. However, if I needed to liquidate my stocks, I could do that in basically one day as long as the market was open and have that transferred to my bank account by the end of the week. On the other hand, with my crowdfunded real estate investment, which is Fundrise, I'll put an affiliate link for them down below. That is an investment where, there's only a quarterly redemption period, and they don't always guarantee redemptions because your money is going into actual real estate investments. So that is why you have to keep in mind the liquidity aspect associated with each of these investments, and just make sure that that meshes in and fits well with your overall financial plan. I always like to have a good mix of very easy to liquidate assets, as well as, a mix of these illiquid investments that may have other benefits that these, more common publicly traded investments do not. So right off the bat, guys, as mentioned, the number one source for me for compound interest income is my M1 Finance dividend stock portfolio. I've been growing that over the last 2 years and documenting it monthly on my channel here. And I will also put a card up in the corner with that full series. And there's a link down below if you wanted to sign up for M1 Finance. It is an affiliate link, so I may earn a commission in the process. It's honestly a fantastic brokerage platform. No trading commissions, automatic dividend reinvestment, and portfolio rebalancing. That is why I like it for dividend investing. And I also have a completely free 30-minute free video training walking you through step by step how to get started with M1 Finance, how to build a portfolio, and earn compound interest from those dividend stocks. So that's completely free, guys, regardless of whether or not you use my affiliate link, just to show my appreciation to you. So that being said, that's my number one source. But talking about other avenues for compound interest, we'll discuss dividends later. Starting off with number 10 here in no particular order, we have high yield bank accounts. So this unfortunately is like the worst way to earn compound interest, because even though, bank accounts are compounded returns, it's a very, very low rate of return in a savings account. So most people out there are going to tell you that it is nearly impossible to save your way to $1 million. And with the returns that you earn from a high yield bank account, honestly, guys, it's just a very negligible amount of money. And when you factor in inflation, you're going to be losing money every single year. So that is a lousy way to earn compound interest, but it is one nonetheless. And right now, the average savings accounts are at around around 0.05% APY. So that doesn't matter too much here, guys. You may want to maximize, how much you're earning with an online savings account. Or, shameless plug here, guys, I want to talk quickly about a startup I invested in called Yotta Savings. It's basically a prize-linked online savings account where every single week, based on how much you deposit, you get a set number of tickets into a weekly lottery. And in that lottery, you can actually win up to $10 million. So if you're kind of bored of traditional bank accounts where you're earning next to nothing and you think that might be a little bit more exciting, I actually find it super helpful in motivating people to save more money, because as you deposit more money, you earn more weekly tickets, and it's fully FDIC insured as well. It's a legit bank, and it's kind of a cool take on old school boring banking. So, bank accounts are not a great source of compound interest. However, it is technically speaking compound interest. You may want to pursue an online savings account to maximize the amount of interest you're earning, or you may want to check out Yotta if you want to check out this company that I have invested in as an angel investor. My referral link is down in the description below. So number 9 is another sort of lousy investment that has largely gone out of style in recent years, and that is something called a mutual fund. So a mutual fund is an actively managed portfolio of assets, typically stocks and bonds, and the goal of a mutual fund is to beat the overall stock market, and the typical benchmark they follow is the S&P 500. Well, what has been found out over the years is that most of these expert stock pickers and money managers are not even beating the S&P 500, and by the time you count or factor in their expensive active management costs, there's really no benefit here to having that active portfolio management. So while you can, technically speaking, earn compound interest from mutual funds, it's becoming less and less popular, and honestly something I don't personally invest in. I have exactly $0 in mutual funds, and I don't know that I will ever change that. Number 8 is a better option for most people if you're looking to eliminate investment fees, and that is simply investing in index funds. So what happens with an index fund is that it's basically a basket of a ton of different stocks, giving you built-in diversification. So if we take, for example, an S&P 500 ETF, something like VOO, that is going to be a small piece of the 500 largest publicly traded companies in the United States. Now, the interesting thing about that is across the entire S&P 500, some of these companies pay dividends and others do not. And if you guys don't know a lot about dividends, I've got another mega video I'll put up in the corner, Dividend Investing for Beginners. It covers everything that you probably ever would need to know about dividends, but I like to geek out on certain stuff, guys, so that is an interesting topic for me. But nonetheless here, guys, what happens with that is you own a small piece of all of those companies. Some of them pay dividends, some of them don't. All of the collective dividends that are earned are actually paid out in a quarterly distribution from the actual fund. So with an index fund, you typically get a quarterly dividend, which you can absolutely reinvest through your brokerage platform in order to earn dividends from those dividends. So obviously, guys, if you want to maximize the amount of compound interest that you're earning, you're going to want to make sure that any distributions or dividends or cash that your investments spit off get reinvested back into the original positions. If you take your money and run, you're not going to be earning new dividends from that amount of money. And essentially, you'll be slowing down how long it's going to take to build whatever goal you have in mind in terms of how much wealth you want. So that right there is probably the easiest strategy for earning compound interest and just not worrying about your investments, is building a passive index fund portfolio. And another shameless plug here, guys, for M1 Finance. One of the reasons why I like them a lot is that they have completely free expert built portfolios of index funds. So if you simply wanted to passively invest money into index funds in a pre-built portfolio that was automatically being adjusted as you go, that way you don't have to worry about allocations or picking individual funds. You can do that absolutely free over on M1 Finance with a $100 minimum investment or just $5 $500 for a retirement account. And if you're investing for retirement, they also have target date retirement funds where you simply put in the year that you're looking to retire or be drawing from that account, and then they'll give you a pre-built portfolio that's going to be adjusted over time for those specific goals. So coming in at number 7 here is looking at a sector-specific ETF. So what we were talking about before with general index funds is a broad market fund. This is a type of investment that is tracking or following a benchmark of hundreds of different companies in all different areas of the economy. So for example, in the S&P 500, you have healthcare companies, you have construction companies, everything under the sun. That's giving you diversified exposure to the entire stock market. However, if there was one particular part of the economy or one, industry or segment that you were very, bullish of, which means you think that it's going to do really well, you could also purchase a sector-specific ETF in order to earn compound interest from dividends or more so asset appreciation. So typically speaking, when somebody rotates into a sector-specific ETF, they're doing so more so on an asset appreciation standpoint where they expect the underlying share price to go up quite a bit in the near future. Or you may, pick one industry in particular that you like, that you want to invest in long term and just, reinvest those dividends. So over on Vanguard, there's a couple dozen different ones. They have like a semiconductor specific ETF. One of the ones that I owned last year was called Jets. It was an airline ETF. And then a friend of mine is big into the Vanguard Financials ETF. So there's all kinds of different ones out there, guys. Just be aware of the fact that if there is like one individual particular area of the economy, one sector or industry that you want to invest in, you could theoretically earn compound interest through a sector-specific ETF. So number 6 is publicly traded REITs. And to be fully transparent, guys, this is something I have exactly $0 invested into. Personally, I'm not a huge fan of publicly traded REITs. As mentioned earlier, I invest in physical real estate as well as crowdfunded real estate, and we're going to discuss that a little bit more later on. But as far as publicly traded REITs go here, guys, this is essentially a public company that owns a bunch of real estate, and then all of the money earned from the operations of that real estate, at least 90% of it must be paid out to the shareholders in the form of distributions in order to be classified as a REIT. Now, while they do sound like a nifty investment, one of the problems with them is that because they do trade on the same exchanges as, stocks, they tend to have the same exact movements that the stocks do. So when the stock market sells off, REITs typically sell off as well. And one of the goals that many, including myself, look to achieve with an investment portfolio is to have your money doing different things at different times. So because REITs have a very high level of correlation to the stock market, it's something I just personally do not have in my portfolio. But if it is something you want to explore more, it can be a pretty decent source for dividends, and you can even find some monthly dividend payers. I just did a whole video talking about the best monthly dividend paying stocks. I'll toss it up in the corner, but the number one on that list there was called O is the symbol. It's called the Realty Income Corp, and this is pretty much the most popular monthly dividend paying stock out there. So that is one of the cool things about REITs. You can find monthly dividend payers, but in all honesty here, guys, there's no true benefit to having a monthly versus a quarterly dividend as long as you're reinvesting them. It depends on the underlying asset, not so much the frequency of that distribution or dividend. So don't worry too much about that or think that a monthly dividend is somehow a lot better than a quarterly or, a semi-annual dividend or something like that. So coming in at number 5 is another boring one, but oddly enough, something I actually just added to my portfolio, and that is a bond ETF. So up until this point, we've talked about real estate, we've talked about stocks, which most people would refer to as equities if we're being fancy. Now we're going to be talking about bonds. Bonds are different because equities are ownership stakes in real companies, whereas bonds are simply debt obligations where you're essentially acting as a bank. bank. Now, bonds used to be a method for preserving your wealth or even having small amounts of growth without much downside risk. But because of this ultra low interest rate environment we are in, bonds are really no longer a profitable investment. So most people these days only purchase bonds if they're looking for more downside risk protection and not having as much downside exposure, not necessarily as a way to actually make money. But the fund that I bought in particular is like a JP Morgan ultra short-term bond, and I believe it's going to make me less than 0.2% as the return there annually in terms of the distribution there. So that's obviously, guys, not going to be inflation, which sits at around 2%. I'll probably be losing, around 1.8% a year if I keep the money in this bond fund, but it's actually just a very short-term thing here where I set some money aside just because I'm actually getting involved in a lawsuit related to my second home that I bought, actually, which is now my full-time residence in Florida. So for those reasons, I put a little bit of my money into that bond fund to take off some risk just in case I need it later on this year, but most likely I'll just be reallocating that money back into my dividend stocks at some point in the fall once I have more certainty surrounding the real estate situation. So bonds tend to be a lot less volatile than stocks. They're a highly liquid investment, but I kind of put them in the same category as the bank, your online savings account or your bank account, where technically speaking, it is compound interest. It's just not a very good source of one. And you're not going to hear of a lot of people, making millions of dollars with bonds. It's possible, but there's just simply put better options available. And bonds today are not the same thing as bonds were 20, 30, 40 years ago. So number 4 is crowdfunded real estate. As mentioned, this is one of my components to my portfolio as well. I've been investing in a platform called Fundrise since around 2018, and I have about 25 grand in total invested in crowdfunded real estate. Now, the way that works is investors from all over the United States are pooling together money, and that money goes into portfolios of physical real estate all over the country. Some of these are properties that are rented out. Some of these are properties that are actively being flipped, and so they make money from a couple of different methods. It could be buying buildings for, positive cash flow, or it could be purchasing something and then remodeling it and then renting it out for a period of time and then selling it later on and making money from that asset appreciation. So I've had a pretty solid experience with Fundrise. It's kind of a boring investment. It hasn't held up as well as the stock market in the last few years in terms of the returns I've made from stocks versus crowdfunded real estate. But I really like being diversified, guys, and I have my quarterly dividends automatically being reinvested, and I'm honestly just going to leave that there forever. I may add more money to it at some point, or I'll just leave it there and see what happens, but that to me is kind of a cool separate $25,000 investment, and hopefully, 20, 30, 40 years from now, that's going to be a massive component, to my overall wealth and overall investment portfolio. So the cool thing about crowdfunded real estate is that it's typically a lot cheaper than buying a real property. If you're looking to get into like a rental property, for example, these days you probably need to have about 100 grand to put towards buying it, closing costs, etc. Most people, simply put, just do not have that kicking around. With Fundrise, which is the platform that I use, the minimum is just $500. So if you guys want to check it out, there is an affiliate link down below for Fundrise. And so your use of that link, obviously, guys, totally up to you, but I certainly do appreciate it, as that is a way for you guys to basically give back to me at no additional cost to you for putting this video together. So number 3 on the list here is my number 1 source of compound interest, and that is dividend stocks. Pretty self-explanatory here, guys. These are well-established, more durable, time-tested companies that have been earning revenues for decades in most cases. And so what they do is they take a portion of their profits and they pass that along to the shareholders, typically in a quarterly dividend, as a means of rewarding them and giving them a reason to stick around. So I have about 20 different dividend stocks in my M1 Finance portfolio. And like I said, I've been tracking that portfolio here on YouTube for the last 2 years, and that is where I have the majority of my money. So if you guys want to check that out, there's a link down below for M1 Finance, as well as that completely free 30-minute video training where I walk you through step by step how to build a dividend portfolio to earn compound interest from scratch. So coming in at number 2 on my list here is Farmland, and I'm guessing that's kind of a weird one, but I'm going to throw you another loop here that you may be totally unaware of, but I actually have a completely separate business related to Farmland. No, I'm not a farmer, guys. You can see my nails here. There's no dirt under these nails here, but what I have is a Farmland investing blog that I launched back in November of 2020 called Farmland Riches. So if you guys want to check it out, I'll link it up down below, or it's farmlandriches.com, but it's pretty much a great online resource that talks about ways to invest in farmland, why people are doing it, and how it's actually a fantastic hedge against inflation and a source of compound interest. Also, guys, Bill Gates is a huge fan of farmland. He's actually the largest private owner of US farmland in the entire world. So historically, farmland has actually beat the S&P 500 over impressively long periods of time, depending on what you look at. It's sort of been this asset that's been heavily slept on. Nobody really thought about it. And then all of a sudden, tons of people like Bill Gates started buying it. So the premise behind investing in farmland comes down to this. All over in the United States, we are building high-rise apartments and multifamily housing, or just single-family housing, on top of existing farmland. Well, it doesn't take a genius to figure out that eventually, when we gotta feed all of those people, where are we going to grow the food? So that's pretty much the premise behind farmland investing. We are destroying, well, not destroying, but we're repurposing so much farmland every single day. And I don't know if you guys have been noticing, the food shortage issues, but especially myself being down in Miami here, guys, every time I do a grocery order, about 25% of the items I'm trying to buy, I can't even get them. So I would imagine this has something to do with, the farmland and the whole food production system, which we're still, as we are moving forward today, continuing to reallocate farmland into apartments without thinking about how we're going to need all of this to feed everybody. So I'm super bullish on farmland. I don't own any of it yet myself, guys, but I do have that whole Farmland Riches blog where you guys can learn about this investment and pretty much how this works overall. So the main platform that I recommend is called Acre Trader. I am affiliated with them, but it's basically a platform where you buy individual shares of farmland and you own a piece of an actual working farm. So if you guys want to check either the blog out or Acre Trader, I'll put links down below. And if you do check out the link for Acre Trader, you'll be able to view live investment offerings right now for potential farmland investments. Now, the last one on my list here, guys, is sort of a more complicated investment vehicle. It's not something I personally own myself, but it's called a MLP, or Master Limited Partnership. And when it comes to investments that allow you to earn compound interest, MLPs are actually one of the best ones out there. So this is actually a type of business structure that is a cross between a partnership and a corporation. It is limited to natural resources and real estate sectors, and it's typically involved in things like pipeline, construction, as well as oil and gas or energy transportation companies. The profits pass through directly to the shareholders of the MLP, and this can often lead to dividend yields of 10% or more from certain investments like this. Another unique characteristic is there's a significant tax benefit to MLP owners, and that is the fact that you have access to the 25% qualified business income deduction, and so distributions are treated as a return of capital. Basically, it subtracts from the basis, the cost basis, and then the gains are deferred until you sell. So it gets a bit complicated there for the scope of this video, but if you are looking to learn more about interesting investments, MLPs are interesting. I don't personally own any just yet, but there is a favorable tax situation and the potential for outsized or higher dividend yields. However, again, just be careful. Don't solely go after high dividend investments, because that dividend could be changed or cut entirely at any point in time. So that covers the top 10 investments here, guys. There are more than this list, but these are the ones that I felt would be the most important and relevant to you. The last thing I want to cover here is the key mistakes to watch out for when looking for compound interest investments. So number one, solely looking at the average returns and not paying attention to risk levels. And again, that just comes down to not fully understanding the investment. If you're just looking at the returns, that is a bad strategy. Number two, not taking liquidity into account when deciding where to invest. So for example, with Fundrise, if I put my life savings in there and didn't realize about the quarterly redemptions that were not always guaranteed, I could have ended up in a bad situation. However, I'm totally fine with that 25 grand being illiquid, because I find there's other benefits to that illiquidity that you don't have with other, more liquid, publicly traded markets. Beyond that, dumping all of your assets in one place. Don't put all of your eggs in one basket. Watch my video on portfolio diversification to learn more about that. Not looking into the underlying trends and risk factors. So in particular, let's pick on MLPs. I would say be very careful of long-term investments in energy because that is a rapidly changing industry. I don't have a single penny in oil and gas companies. I do own utility companies, but they're more on the distribution side, not the actual, extraction of fossil fuels or the generation of electricity. Also, failing to consider tax treatment or tax consequences is another big risk. And then lastly, watch out for businesses that are not adopting to current trends or changes in overall behavior. So anyways, guys, that is going to wrap up this video. Those are, in my opinion, 10 of the best sources out there for compound interest. And as I had said earlier, you really have to be careful with this because if you're earning compound interest from your investments, you have compound interest working for you. But if you get behind and you get loaded up with credit card debt, and then you have your credit card interest payments accruing more interest, you have the exact opposite working against you, and it can be a very slippery slope. Just like you could have that gigantic snowball of assets building more assets, you can just as easily, if not even easier, build a gigantic snowball of debt that keeps on building and getting more and more out of control. So do bear that in mind, guys. Understand that compound interest is a very fair and equal opportunity for most people, but it does work in both ways, and it can work for or against you. So anyways, guys, that is going to wrap up this video. I hope you enjoyed it. If you did, make sure you drop a like, subscribe, and hit that bell for future notifications. Also, guys, if there's any topics in general that you want me to cover on this channel or some video ideas, I'd love to hear what you guys think. So feel free to leave me a comment down below. As mentioned, there's all of those links down in the description if you want to check out Yotta Savings for that prize-linked lottery savings account, M1 Finance for dividend investing, Acre Trader for farmland investing, or potentially Fundrise for crowdfunded real estate. But thank you guys so much for watching, and as always, I hope to see you in the next video.